All right, let's break down the single most important rule in all of finance. Seriously. By the end of this, it's going to feel so obvious you'll wonder how you ever saw it any other way. And just a quick heads up, this is all for educational purposes, not financial advice. Okay, let's get into it.
You've heard the pitch before, right? Someone comes along promising these incredible, life-changing, super high returns.
And they swear on their life there's absolutely no risk. None. It sounds amazing, the perfect investment. But come on, let's be real for a second. If you ever hear that promise, you need to know there are only two possibilities. They're either flat out lying to you, or they just fundamentally do not get how money actually works. Because in the world of investing, there is one law you can never, ever break. And that brings us right to the heart of it all. This is the one unbreakable rule that sits underneath every single investment you will ever make. It's really this simple. To get a higher reward, you have to take on higher risk. That's it. There are no exceptions, no secret loopholes, no one weird trick. This is the law of the land. So the game isn't about avoiding risk. It's about understanding it. You know what? Think of it like the heat on a stove. It makes perfect sense. If you use low heat, your food's going to cook slowly and safely, no problem. But if you crank that dial all the way up to high heat, yeah, it'll cook way faster, but you also dramatically increase the chances of burning your dinner to a crisp. Money works the exact same way. You just can't get that fast growth without being willing to handle bigger swings. And this is a huge mindset shift. Risk itself isn't the enemy. Unmanaged risk is. You know, it's kind of like the difference between a nice, cozy fire in your fireplace and an out-of-control fire in the middle of your living room. The goal is to manage the heat, not to get rid of it completely. So if we're gonna manage it, we first have to know what we're actually talking about. And this is where most people get it wrong, and it leads to all kinds of bad decisions. See, most beginners think risk just means losing money, but that's not the whole picture. Really, risk is just about how much your results can vary. It's the range of possible outcomes, both good and bad. It's the potential for those wild swings. Let's make this real. Ask yourself this question. Could my investment plausibly drop 30% in a single year? If the answer is yes, well, that's a measure of its risk. What about 50%? Or, hey, even more? That potential for a huge drop, that variance, that's the risk. And here's the crazy part. The market literally pays you a premium for your ability to stomach that stress without freaking out and selling. Now for beginners, this variance, this risk, really shows up in three main ways. First, you've got price risk. That's just the simple fact that the price goes up and down. Second is time risk. This is the danger that you'll need your money at the absolute worst moment and have to sell low. But the third one, this is the big one. Behavior risk. This is you getting in your own way. Panic selling when things look scary, or panic buying when everyone's getting greedy. Honestly, most people don't lose to the market. They lose to themselves. Think about it like a ladder. Down at the bottom, you've got cash. It's safe, very low movement, but inflation is slowly eating it away. You climb up a rung to bonds, a bit steadier, moderate returns. Then you get to broad stock ETFs, which offer higher long-term growth but come with much bigger drops. And then way up at the top, you have things like Bitcoin or single stocks, the highest potential swings and the highest uncertainty. The classic beginner mistake, trying to start at the very top of the ladder, completely unprepared for how shaky it is up there. Okay, so that's the theory. Now let's make this super practical. It's time to shift from these big market ideas to your own personal situation. All right, here it is, the single best tool for figuring out your own risk level. I call it the sleep test. It's so simple. If you are lying awake at night worrying about your portfolio, your risk is too high, period. It's not a sign of weakness, not at all. It's just a sign that your investments are out of sync with your life. The market doesn't care one bit about your emotions, but your emotions will absolutely control your actions. And this gets us to how the pros think. See, amateurs try to avoid risk altogether. Professionals, they learn to budget it. They treat risk like a resource, something to be carefully allocated, not something to run away from. A great way to think about it is like a calorie budget, right? You know you can't just eat junk food for every single meal, but you can absolutely plan for a treat here and there. Investing is exactly the same. You decide how much of your portfolio is going to be your safe, steady foundation. And then you allocate a smaller piece to be your engine for growth, the part with higher volatility. It's about having a plan instead of just closing your eyes, winging it, and hoping for the best. So, what does a plan like that actually look like in the real world? Let's walk through a simple but really effective structure that literally anyone can use. It's called the core and satellite approach. Basically, the vast majority of your money, let's say 80 to 95%, that's your core. The small remaining slice, maybe 5 to 20%, that's your satellite. And each part has a very different job. The core is all about survival. It's made of boring, diversified, long-term stuff that's designed to just grow steadily over time. The satellite, though, that's for upside. That's your learning zone. It's where you can experiment with higher risk things without ever worrying that you're going to blow up your entire financial future. It lets you chase some excitement without risking the whole farm. And having a structure like this is so important because it protects you from the single most dangerous psychological trap in investing. It's that moment you hear someone say, "Dude, look how much this went up." That sentence is like a siren song that has led countless investors to crash on the rocks.
Why is it so dangerous? Because your emotional brain is wired completely backwards for markets. It sees an asset that's shooting up and thinks, oh, that's safe. And it sees something that's dropping and thinks, whoa, that's dangerous. But the market's reality is very often the complete opposite. After something has had a massive run-up, that's often when the risk is highest. And after a big crash, well, that's where the greatest opportunity can be. You don't need to predict the future. You just need a plan that stops you from making dumb, emotional decisions. So here is your first action step. It is incredibly simple. I want you to open the Notes app on your phone and just write this sentence: my portfolio should match my life. That's it. Then use that sleep test we talked about. Be honest. If a 20% drop would totally wreck your peace of mind, you need to lower your risk. If you know you could handle that calmly, then maybe you've got the capacity for more. Because at the end of the day, here's what it all comes down to. The best investment isn't the one with the highest possible return on paper. The best investment is the one you can actually stick with, through the tough times, through the downturns, when holding on is zero fun. It's the one that lets you sleep at night. So the only question that really matters is, what's yours?